Something changed, and the people who make money from your confusion did not rush to explain it. In the last 2 years, without a big speech from Washington, without a bright red warning from your bank, and without most retirees hearing a word about it, the practical rules around the old $10,000 bank threshold got much harsher. Most people still think they understand that rule because they heard about it decades ago. They think it means this: if you move more than $10,000, the bank files a report, and life goes on. That is not the world you are living in now. The world you are living in now is a world where a bank can delay your withdrawal for days, where a pattern of smaller transactions can be treated as evidence that you were trying to avoid reporting rules, where digital transfers and crypto activity increasingly feed the same reporting machinery, where businesses that take your money now have much stronger incentives to report you quickly and precisely, and where a number written into law in 1970 is now catching ordinary retirees doing ordinary things. That is the part people miss. The real danger is not that criminals get caught. The real danger is that normal people behave normally while the rule book quietly changes around them. I have spent a lifetime studying systems, banking systems, tax systems, incentive systems, markets, bureaucracies, human behavior. And one thing I learned a long time ago is that when the rules become unclear, the advantage does not go to the honest person. It goes to the informed person. This is not a story about paranoia. This is a story about preparation. And the reason I want you to pay attention is simple. If you try to move money today the way a sensible American might have moved money 20, 30, or 50 years ago, you can get frozen, flagged, delayed, or reported even when the money is completely legitimate and the purpose is completely ordinary. That is not theory anymore. It is already happening. Let me show you why by starting where this becomes real for most people. Not with a regulation, but with a husband and wife. Martin was 71. Carol was 68. They lived outside Phoenix. Martin had spent nearly 4 decades as a regional manager for a paper distribution business. Carol had been a registered nurse for roughly 30 years. They were not reckless people. They were not flashy. They were the kind of people America claims to respect. They worked, saved, paid their bills, and tried to avoid unnecessary debt. Last October, they decided to replace Carol's car and pay cash. The final number was a little over $40,000. Martin went to the bank the next morning, filled out the withdrawal slip, and waited. Instead of cash, he got a private meeting. A branch manager came out and asked him to step into an office. Then the question started. Why did he need the money? Who told him to make the withdrawal? Had he received any unusual phone calls? Had anyone emailed him, texted him, pressured him? Had he met someone online? Think about that for a moment. A 71-year-old man with no cognitive impairment, no fraud history, and decades at the same bank was being treated like a possible victim because he wanted to buy his wife a car with his own money. When he finally convinced the branch manager the transaction was legitimate, he did not get the cash that day. He was told the withdrawal would be delayed for 72 hours. So now the dealership had to hold the car. Martin had to explain himself, and even after the delay, the story was not over. Within 30 days, he received notice that a suspicious activity report had been filed on the transaction. That report entered a federal database and now sits there for years, tied to future transaction patterns, cross-referenced against whatever comes next. Martin did nothing wrong. That is the point. The system no longer waits for wrongdoing. The system increasingly reacts to deviation. And once you understand that, you understand the rest of the story. The foundation of the whole problem is a frozen number. The $10,000 reporting threshold was written into the Bank Secrecy Act in 1970. That was a different country. Gas was measured in cents. A new home cost a fraction of what it costs now. $10,000 could buy things that would make a young person laugh today. In practical terms, it was an enormous amount of money. It was the kind of amount that might actually separate ordinary activity from obviously unusual activity, but the number never moved. That is the part that should bother you. The law stayed fixed while the real world inflated around it. If that threshold had simply been adjusted the way Social Security and tax brackets often are, it would be somewhere around $80,000 in today's money. Instead, the government left the original number in place and let inflation do the rest of the work. So what used to catch people carrying suitcases full of cash now catches retirees paying for a car, replacing a roof, helping a grandchild, covering a medical procedure, moving proceeds from a home sale, or handling a pension rollover. In 1970, the $10,000 rule was aimed at unusual cash behavior. In 2026, it is aimed at ordinary American life. That is the first thing I want you to see clearly. The second thing is that the legal and practical environment around that frozen number got more punishing in just the last 2 years. The first major shift is what I would call the senior withdrawal freeze. Banks were given stronger guidance and stronger legal cover to delay transactions when they suspect elder financial exploitation. In plain English, that means the bank's software can see a transaction that does not look like your historical pattern, flag it, and push it into human review. The software does not know your intentions. It does not know you have been planning that purchase for months. It does not know your contractor is waiting, your surgery is scheduled, or your grandchild needs the money by Friday. It only knows you usually take out $300 and now you want $10,000 or more. That is enough to start the process. Once it starts, your money can be delayed for hours or days. In many states, banks now have legal immunity when they freeze first and ask questions later under elder exploitation standards. That tells you everything about the incentives. If they release your money and a fraud later appears, they take risk. If they delay your money and they are wrong, they usually suffer almost no consequence. So what do rational institutions do under that incentive structure? They freeze first. That is not personal, that is economics. And if you are over 60 and you suddenly want a larger amount of cash than your prior history suggests, you are no longer just a customer. You are a pattern variance. That is a miserable way to be seen by your own bank, but it is how the machine thinks. The second shift is even more dangerous because it introduces actual criminal risk for behavior many people think is just common sense. This is the structuring trap. Under federal law, it is a crime to break deposits or withdrawals into smaller amounts for the purpose of evading the $10,000 reporting requirement. But penalties are not symbolic. The statute carries the possibility of prison, fines, and forfeiture. Now here is where ordinary people get into trouble. They say to themselves, I do not want paperwork, I do not want questions, I do not want attention. So instead of moving $12,000 once, they move $6,000 twice, or $8,000 this week and $8,000 next week, or a sequence of amounts they believe looks safer because each individual transaction is under the threshold. That is exactly the pattern the system is trained to notice. And the ugly part is that the money does not have to be dirty. The source can be perfectly clean. The purpose can be perfectly legal. The government only has to believe the pattern was intentionally designed to avoid reporting. Years ago, people mostly worried about obvious patterns in the $9,000 range, but the detection systems got better. Banks upgraded the software. Patterns that once passed quietly now trigger review at lower amounts and over longer windows. So the retiree who thinks he is being careful by staying under $10,000 may actually be doing the one thing most likely to turn a routine transaction into a much bigger problem. I want to be very blunt here. If you need to move $12,000, moving $12,000 in one clean, documented transaction is often far safer than trying to look invisible with smaller pieces. People lose money not because they are dishonest, but because they are trying too hard to avoid attention from a system that interprets avoidance as its own form of evidence. The third shift is the merging of digital payments and newer financial rails into the same broad reporting machinery that many older Americans still associate only with cash for a long time. Many people believe there was a clean line between traditional bank activity and everything else. Cash over here, peer-to-peer apps over there, crypto somewhere off to the side. That line keeps disappearing. Crypto exchanges are now subject to more direct reporting. Large crypto transactions are being pulled into reporting frameworks that older investors often do not even realize apply. At the same time, thresholds for third-party payment reporting have been falling sharply, with the schedule moving down year after year until it reaches $600. That is the part that changes behavior. A retiree can sell a hobby item, receive reimbursements, move money around with family, use digital apps for convenience, and suddenly find that activity producing tax forms, records, or review trails they never expected. Again, the issue is not always wrongdoing. The issue is visibility. The machine sees more than it used to see, and it keeps more than it used to keep. The fourth shift is the explosion in the importance of Form 8300 reporting and the penalties surrounding it. Most retirees have never heard of Form 8300, but businesses know it very well. If a business receives more than $10,000 in cash, cashier's checks, or money orders from you in a covered transaction, the business is required to file a report with the IRS identifying you in the transaction that touches far more of life than people realize. Car dealers, attorneys, contractors, jewelers, real estate professionals, others depending on the facts, and related transactions can be aggregated. Pay $6,000 today and $6,000 next week for the same job. And in substance, you may still have a reportable $12,000 transaction. Now add stronger filing requirements and larger penalties for businesses that get it wrong or file late. What happens? The incentive becomes overwhelming. The business reports quickly, carefully, and completely, because the business has far more to lose by underreporting than by overreporting. So once again, the system is designed to make other people extremely cautious about your money, even when your money is ordinary. A contractor taking your payment is no longer just thinking about fixing your roof. He is thinking about his paperwork, his exposure, his filing obligations, and the penalties. If he misses something, that means your transaction is entering a more formal, more rigid process, whether you understand that process or not. The fifth shift is what I would call the inflation cascade. This one is not a new law. It is the mathematical consequence of leaving that 1970 threshold unchanged for 55 years while the size of normal life kept growing. A kitchen remodel can cross $10,000. A used car can cross it. A medical bill can cross it. Helping a child or grandchild can cross it. The proceeds of a home sale cross it. A late spouse, retirement distribution can cross it. Insurance settlements cross it. Routine retirement transactions now trigger rules that were built for a different financial era. That is why so many normal retirees are now tripping reports, reviews, freezes, and filings multiple times a year without understanding why. They did not become suspicious people. The system became much more sensitive while the threshold stood still. Once you accept that, the response becomes obvious. You do not solve this by panicking. You solve it by changing how you prepare. The first protection move is simple and free, and it may be the highest value move in this whole conversation. Pre-notify your bank before any larger transaction. If you know you are going to withdraw a deposit or transfer a meaningful amount, especially something around $8,000 or more, call the branch manager in advance, explain what the transaction is for. Ask them to note it in your file. Why does this matter? Because when the software flags the activity, the human reviewer sees context immediately. Context does not stop automatic reporting where the law requires it, but context often helps your money move when you need it to move. Most of the misery in these situations comes not from the report itself, which you may never even directly feel, but from the delay, the uncertainty, and the humiliation of being treated like a risk while you are just trying to execute an ordinary life event. Pre-notification reduces that risk. The second protection move is to stop accidentally structuring. Do not break a transaction into smaller pieces because you believe smaller means safer. If the purpose of the split is to stay under the threshold, you are walking into the exact trap the system was built to catch. There are cases where separate payments have a real business purpose and real timing logic. Fine. But the threshold should never be the reason. If the threshold is the reason in your head, you are thinking the way the prosecutors assume you were thinking. That is a bad place to be. The third protection move is to use wires rather than cash for larger transactions, whenever the other side will accept it. Older Americans often grew up in a world where cash felt certain, final, and private. Today, cash is often the most operationally troublesome route for legitimate larger transactions. Dealers often prefer wires, businesses often prefer wires, and wires typically avoid some of the practical friction that physical cash creates under the old reporting framework. Cash feels tangible, I understand that. But in today's system, tangible often means traceable, delay, prone, and form. Heavy in exactly the wrong ways. The fourth protection move is to separate digital payment activity by purpose. If you use one account for family reimbursements and the same account for occasional side income, sales, or quasi-busyness activity, you are inviting confusion. The numbers get aggregated, forms get generated, sorting it out later becomes a nuisance at best, and a headache at worst. Personal flows belong in one lane, anything even remotely business, like belongs in another. That is not overkill. That is bookkeeping as self-defense. The fifth protection move is to build a documentation habit before you think you need one. For every larger transaction, record the date, amount, source of funds, recipient, and purpose. A notebook works, a spreadsheet is better. Save emails, save invoices, save contracts, save anything that makes the story of the transaction clear to an outsider. Why? Because innocent people often lose these fights not on the merits, but on the paperwork. When the government or a bank reviewer looks backward, they do not see your intentions. They see patterns and documents. If your documentation is clean, your defense is clean. If your documentation is weak, then you are asking a stranger to trust your memory after the fact. That is not where you want to live. There is one more move that is especially useful for older Americans because it can reduce the chance of these painful withdrawal delays before they happen. You can work with your bank on a written authorization framework for senior transactions, a kind of standing understanding that identifies the categories of activity that are normal for you, names a trusted contact, and makes clear that certain types of transactions fit your legitimate retirement pattern. Not every bank markets this clearly. Many people never hear about it unless they ask. But the basic principle is sensible. If the bank already knows that larger transactions for medical expenses, family gifts, home projects, or car purchases are within your normal pre-cleared behavior, then a future transaction is less likely to hit the full delay cycle. That is not a magic shield, but when Martin and Carol finally put that kind of protection in place after their experience, later transactions moved much more smoothly. That tells you something. Systems behave better when you do not wait until the emergency to explain yourself. Now step back and look at the whole picture. The $10,000 rule did not become more dangerous because one politician made one speech. It became more dangerous because a stale threshold sat still while the real economy changed, because compliance systems got better at finding patterns, because banks got stronger incentives to freeze rather than release, because digital payments widened the reporting net, and because ordinary life now crosses a half-century old line all the time. That combination is what hurts people. A lot of Americans over 60 still believe the banking system mainly cares whether their money is legitimate. That is only part of the truth. The system increasingly cares whether your behavior looks normal according to rules you were never taught and software you will never see. That is why an honest retiree can get into trouble. Not because the source of funds is bad, because the pattern offends the machine. I want to leave you with the only practical conclusion that matters. Do not wait until the day you need the money to think about this. Do not learn these rules at the teller window. Do not decide in the parking lot of the dealership. Do not improvise when the contractor is standing in your kitchen, and do not assume that because you have done business the same way for 40 years, the bank is still operating under the same assumptions. It is not. The retiree who says, "I am honest, so I have nothing to worry about," is thinking morally. The system is thinking procedurally. You need to think procedurally too. Call ahead, document the purpose. Move clean amounts for clean reasons, use wires when they make sense. Separate digital lanes. Put the authorization structure in place before you need it. That is how you keep the system from pushing you around. People like to say that money is freedom. That is only partly true. Money you cannot move when you need it is not freedom. It is a balance. And the whole point of retirement is not just to have balances on paper. The point is to have control when life asks you to act. The rules changed. Most people never got the memo. Now you did.